Everything should be smooth from here on. So, good evening, guys. I am Alhaji Myke, and I'll be your host on this 10 days boot camp. I hope you guys can hear me well.
Yeah.
Right.
Yes, yes.
Like I stated initially, this boot camp, I believe I stated it earlier. This boot camp is not going to be it's not going to be like a basic class, but it's going to be establishing on what you already know. Are we together? It's going to be establishing on what you already know. So before we get started, right? Okay, I'm actually going to be teaching you guys what I personally look out for when I'm trading. I'm going to be teaching you guys, the things I look out for, and basically everything I do, sure. So here are the few things I'm going to be teaching people during the course of this boot camp. Right, here are the few things I'm going to emphasize on during this boot camp. So we'll treat market structure again because I believe that's the foundation of everything. So we're going to treat market structure. We'll treat market structure. Then under market structure, I'm going to explain short-term highs and short-term lows to you guys because it's very important and I use it a lot. So it is one of the basis of my strategies. Michael, please, if you don't mind, turn off your mic.
Okay.
Yeah, thank you. So it is one of the basis of my strategy. So I'm going to be emphasizing on short-term highs and short-term lows, right? Then I'm going to also, I'll teach you people the power of three candles, right? Power of three candles. Now, it is something I use especially when I'm scalping. Power of three candles. It is something I use when I'm scalping mostly. Now, it's kind of, you don't really, it is, how will I put this? It has more or less, it has more to do with market structure, but on a higher time frame. And you're using, basically studying three candles to get your entry and your exits from those three candles. Now, this power of three candles, you could also use it to stack up positions and other things. So basically, I would explain it to you people during the course of this bootcamp. Um, I'm going to revisit liquidity. I'm going to revisit liquidity. I'm going to revisit liquidity because all these are foundation of the strategy. Then we're going to look at premium and discount pricing. Now, after all this, I'm going to show you guys a couple of schematics that also play out a lot in the market. But then, all this aside, I'm a scalper basically. I'm a scalper. I've never hidden it before. And most of these things I'm going to be showing you are things that are going to play out on literally almost any time frame you look for. Literally almost any time frame you open. You could go to the 1 hour time frame, you see a setup with it. You go to the 5 minutes time frame, you're going to get a powerful setup with it. Yeah, let's forget AMD. AMD, but I believe everything would be explained in the body, but let's just add that AMD. So I don't forget. Accumulation, manipulation, distribution. Alright, so everything, it literally works in every market, works in every single market, works on every time frame. Yes, it's not restricting you to being a scalper, to being a swing trader or whatever. No, it will work for you well on any time frame you're looking for. You look out for it. All right. So we're going to start on market structure because I said today's class is going to be an introduction. So basically everybody understands market structure already. But today's class, I'm just going to revisit it again. Just because everything here is going to be building up on market structure. So I'm just going to revisit it so that people would have, so that it will just be fresh in your head. And probably if your tutor left out something whenever they taught you about market structure, this might make a difference for you. I don't know if that makes sense. Are we together? Are we together?
Yes.
Okay, perfect. So give me a minute. So let's look at something like this. Okay, before I start, I believe most of you should have an idea of should understand the major difference between a bullish market and a bearish market, right? The major difference between a bullish market and a bearish market is that in a bullish market, you expect the candles to be forming higher highs and higher lows, while in a bearish market, you expect candles to be forming lower highs and lower lows. Now, it's usually recommended that you trade in line with the trend. It's recommended you trade in line with the trend. But I believe there are times whereby, okay, because the basic difference between a bullish and a bearish market is the formation of higher highs and higher lows. Now, you open the 1 week time frame, okay, or the 1 day time frame on some pairs. Let's say something like BTC, for example. You put the 1 day time frame on the 1 week time frame on BTC, and you're going to see it is bullish as hell, right? Because it keeps creating higher highs and higher lows on the 1 week time frame. I mean, the last time we saw a major low get taken out was it's several years back. I think 2018, 2019. That was the last time we saw a major loot get taken out on BTC, right? That is on the weekly time frame. But then when you drop down to the 15 minutes time frame or the 5 minutes time frame, you're going to notice that it is bearish. Now, if there's a trade in line with the trend, do they mean that regardless of the fact that the market on the higher time frame is okay, the market on the higher time frame is bullish, are you supposed to just keep on looking for buy opportunities even if the lower time frame is showing that the market is bearish? It isn't a rhetorical question. I also want to answer.
Come again.
Okay, I gave an example, right? I said if you should they said trade in line with the trend, right? Which means if you are seeing a bullish market, you should be looking for buy scenarios, right? And if you are seeing a bearish market, you should be looking for sell scenarios. Am I right?
Yes.
Very perfect. Now, in a situation, I gave you the example of BTC. The last time we saw a major low get taken out on BTC, that was somewhere around 2017, 2018. That was a major low on the weekly time frame getting taken out, which means on the higher time frame, BTC looks bullish, right? Because it keeps creating higher highs and higher lows. But then when you drop down to a time frame like the 4 hours time, not even 4 hours, like the 1 hour 30 minutes time frame, you're going to notice that that BTC now is forming lower highs and lower lows. Sorry, yeah, lower highs and lower lows. That is, it is bearish. I'm not talking about this instance, so I'm just giving a scenario. Now, when you notice something like that, what are you supposed to do? Are you supposed to be looking for buy scenarios because the weekly time frame told you that the market is supposed to be bullish, or you're supposed to look for sell scenarios because the lower time frame says so? What are you supposed to do?
If the market is retracing, I think there might be room for a sell because once it retraces, it will always retrace before going back. So I feel if there's an entry for a scalper, it might be a good opportunity.
Okay, good answer. Someone else, please. Can I get another person opinion? Can I get a second opinion, please? Anybody, I give all of you permissions to speak.
Good evening, Aliu here. So, based on the scenario, I think the lower time frame is showing us real time what is happening, but the bigger picture on the higher time frame has not been, how do I call it? Not, it's going to be bearish on the long term. So you go for a sell.
Okay, because sorry, someone is trying to call me and it's really messing with me. Ali, please come again. I didn't get what you said.
You said on the higher time frame is showing bullish, but on the lower time
Yeah.
frame is, let's say, was it 1 hour 30 minutes? You said is now selling.
Yeah.
So I believe long term is still going to reflect selling. Long term, the higher time frame is still going to reflect selling, but in real time, it is real time it is selling, but long term it's buying.
All right, good. Good answer, good answer. But I'm going to answer that now. So under this market structure, before I go, let me just write this down so I don't forget. Under this market structure, I'll teach you guys targeted and protected highs and lows. All right, protected highs and lows. Because in a scenario like this, you have to identify all the targeted and all the protected highs and lows. So you're going to know if you are going to be selling, you're going to know where you use as your take profit region, and if you're going to be buying, you're going to know where you use as your stop loss. I don't know if that makes sense. So the thing with the market is highs and lows. Right, perfect. So the thing with the market is what people don't know is that the market has two major trends, right? That is regardless of the impulsive retracements and the consolidating trend. No, those ones are just aside those ones, there are two major trends here. That is, I call one. Let me say the main move. The main swing, or I can't remember the names for this picture. But then there's a main structure and there's always a minor structure, or let's call it a substructure. Now, the main structure is what price is doing on the higher time frame, and the substructure is what price is doing on the lower time frame. Are we together? Are we together? Now look at this, for example, here. This move from down here to this point, move from down here to this point here, would have been the move from here to this point is an impulsive move. And let's say, okay, the market was bullish in this scenario because it took out the high. So we are going to look at this as the main structure, because obviously you expect price to always continue with the structure. But then this retracement back here, let's say this was like the 1 day time frame, and you trading from the 15 minutes catch a trade from here. You know how many R you can do down to this point. Now, this is the minor structure or the substructure, because it is what price is doing within, like, it is this minor movement that happens against the trend. It is more or less a retracement, but it's also a trend. Because a trend on a movement on the 4 hours time frame can be a trend on the 5 minutes time frame. I don't know if that makes any sense. One candle on the 4 hours time frame can serve as a trend on the 5 minutes time frame. Does that make any sense? I mean, you can see one long candle coming down, and when you go to the 5 minutes time frame, you see a couple of break of structure. You can see like 10 different trade entries there, because it has formed the whole trend. So before we go on, let me just simplify this for you guys, because if I keep talking about this, you just end up confusing yourself. So there's this general rule to the market here, whereby price takes out a structure. Price takes out a structure. And what I mean by a structure is a high, a low, and a retracement. A high, a low, and a retracement. You understand? So let's say price takes out the structure now, for example, because this is let's say this is the low, this is the high, and this is meant to be the retracement. This movement comes to take out the structure, right? Once this movement has taken out the structure, it's forming a whole new structure on its own now. And we'll now expect price to do is for price to come back. The high has been taken, so this is the new low, this is the new high, and this is going to be the new retracement before we expect price to come back and take it out. Are we together? Are we together? Can you guys hear me?
Yes.
In everything, this is like the most important part. The most important thing you should remember: the high, the low, and the retracement. Now, after price takes out the structure, the general rule is that price is expected to return back into at least 50% of that level, right? Because the 50% level, okay, anything below 50% is usually known as the discount level. And anything above 50% is the premium level. I don't know if you've ever heard when someone say the market is overbought. When someone says the market is overbought, it means people have been constantly buying. And at this point, people have been constantly buying. And you should expect that you see corrections. Are we together? It means that price has moved into a premium level. I'll give you an example. Let's use a life scenario, right? I think one of my trades I used petrol in one of my trades as an example. So in 2011, actually it was 2011, during good luck time, when good luck initially removed fuel subsidy, that was all fuel going from as high as 60 naira to 145 naira per liter, right? Now, from 60 naira to 145 naira per liter, that is fuel being at a premium level. After the whole protest of the masses and everything, we saw them balancing the price at around 90 naira per liter. Now, that is more or less a retracement. Are we together? So it is the same logic that applies to every single commodity you see on your charts. Once price pumps like that, and most of these commodities get really expensive, you should always expect a clapback from the community. I mean, Bitcoin getting to $70,000. If you've always noticed, whenever it gets to a level, there's this psychological resistance. For it to break $70,000 is always difficult. It is not that it can't do it; it's the fact that the community are not ready for it to happen. I mean, it's supply and demand that moves this market. Are we together? People are seeing that it is already overbought at that level, and people are looking to buy in at a discount. So that is why you end up seeing retracements. Are we together? Are we together?
Yes.
So this is just me using a life scenario as an example here. So look at this. You use your Fibonacci tool to identify these levels. All these ones, I know we know this one already, right? So when price breaks a structure and you are looking to buy, you should be looking to buy below this level, below your 0.5 level. Ideally, the optimal trade entries are 0.71, 0.61, and 0.71. Those are your optimal trade entries. Are we together? Those are the optimal trade entry levels. Now, those are the optimal trade entry levels. Can you guys hear me? Hello, can you guys hear me?
Yeah, go ahead.
Okay, good. Those are the optimal trade entry levels, the 0.61 and 0.71 levels. Now, anything below that level, right? If you have a good point of interest below that level, you already have one of the confluences you need to take that trade. So basically, what you're going to be doing is on the higher time frame, you want to identify what part of the circle the commodity or whatever here you are looking at is trading on. Right? On the higher time frame, you want to identify what part of the circle it is. Is it overbought? Are we supposed to start expecting a retracement now? If you're expecting a retracement, when I explain the short-term highs and short-term lows, I'll show you how we could use this as confirmation for when trend might change. Are we together? So once you know you're expecting retracement, okay, price has broken out. We should be expecting price to retrace back into 50% level. And one more thing you must know is that before you can take any, what do you call it? Before you can recognize any level, before you can recognize any structure rather, before you can recognize any structure, there has to always be liquidity sweep. There has to always be a liquidity sweep. But oh, I don't want to treat all this things scatteredly. If not, I'll just briefly explain the liquidity. But I don't want to scatter everything. So let's finish your market structure. The next session we're going to talk about liquidity. So it's after liquidity, I'm going to talk about this targeted and protected highs and lows because it is the key factor there. Are we together? Are we together? Can you guys hear me?
Yes.
So basically, in a nutshell, it's expected that after you see a break of structure, you don't want to start buying. If it's a bullish scenario, you don't want to start selling after this break of structure. You want to wait for price to drive back into at least 50% or even go below. The optimal trade entry level, remember, optimal trade entry levels, OT, that's optimal trade entry levels, are 0.61 to 0.61 to 0.71 levels on your Fibonacci tool. Now, anything below 0.79 level anything below 0.79 level can lead to a whole change of trend. Are we together? Which means that if you are expecting that price is going to pick up, like you're expecting that this is just going to be a retracement, you just drop down. Where's that so? You're expecting that this just drops down expect that this just drops down and picks back up from here, right? If you're expecting that, it means that from 0.61, 0.710, you should have started seeing rejections. You just don't want impulsive move to break through 0.61, 0.71 and go straight to 0.79. Anytime you see something like this, most likely price would come back and take out this low. Every time you see just an impulsive move going down, price would most likely take out this low. Are we together? Are we together?
Yes.
Okay, so these are the important levels on your chart in the market structure. Now, I think we still have time, so let's talk about something else let's talk about something else. All right, so short-term highs and short-term lows. I don't know if you've ever heard of SMS before. Shift in market structure. Has anyone ever heard of SMS before?
Yes.
No.
Okay. An SMS is a classic example of a short-term high and short-term low. I'm going to illustrate now. In a situation, right? Let's say price is selling. I forgot to turn this on. Right, so let's go with this. We are selling here, right? We are selling. We are selling. Then suddenly we have a liquidity sweep over here, right? It's just an illustration. I've not explained liquidity sweep yet. So we have a liquidity sweep over here, right? And we have something like this. Right. So this is a typical example of a short-term high because this high was not in existence before. This high was not in existence before. Look, it was engineered after price swept the liquidity existing here. So it literally engineered this high, retraced down, and came back to take out the high. Are we together? Are we together, guys?
Yes, sir. Yes, sir.
So this is a short-term high. Short-term high is an engineered high, a high that wasn't in existence during the whole previous trend, but then price suddenly created it after taking out a low with a liquidity sweep or something. So it was basically engineered and it was taken out. Now I'm going to give you rules to trading with short-term highs and short-term lows, right? So there are basic rules. And like I said, everything boils down to liquidity. There must always be liquidity taken out. Always. Now, when trading with short-term highs and short-term lows, you don't need inducements. You don't need inducements. You just need price to take out a previous liquidity and give you the short-term high. Now, the thing is, this short-term high must always be breached with an imbalance. With an imbalance.
Hello, sir.
I
Come
believe you guys
again.
know what an imbalance is.
Yes, but there was something you said I wanted to hear. You said we don't need an inducement. We need it to take out a liquidity, right?
No. A previously existing liquidity. You don't need an inducement when trading
Okay.
short-term highs and short-term lows. You just need to take previous liquidity.
Okay.
All right, so it has to breach with an imbalance. Now, an imbalance, oh shit, I left this tool on. I believe you guys know what an imbalance is, yeah? So let's take, an imbalance is the gap that exists between three consecutive candles, right? Is the gap that exists between three consecutive candles. Something like this. Who I picks out so? All right, so something like this. Let's take this as candles. All right, so we have three candles. So we have three candles like this. Okay, so we're going to take these three as candles, for example. So this gap that exists between these three consecutive candles, that is between the high of this candle and the low, between the high of this candle and the low of this third candle. is what we're going to regard as an imbalance. Are we together? So you want, oh shit. So you want that every single time a short-term high is breached, it is breached with an imbalance existing. And if you should go back and check, because mostly this is something I use mostly in the 5 minutes time frame. You go back and you check it on the 5 minutes time frame. Let's look for examples. Okay, let's look for an example. Let's just see if we can get an example very fast. So go down to the 5 minutes time frame. And it plays out a lot on Euro USD, not even GEO. This is something I see often on Euro USD. Okay, so let's say I just want to see if I can get an example to show you guys briefly. Oh, perfect. Can this serve as an example? Sweep, short-term high, imbalance, and it came back to pick it. I don't know if you can see it. Look over here. This is a sweep, right? I left this tool on. Right, so this is a liquidity sweep here. Right here, after the sweep, it formed this high because it didn't take out those previous highs. No, it formed this one. Then price came back to still sweep it and give us this imbalance here. Sweep, imbalance. It came back to fill the imbalance. Now, someone would have taken a trade from here. Could have gotten a trade from here. Targets this high. Take your profit and you get out. But this is just a minor example. It's just a minor example. If you should go back and look at it, sorry, as we are going more, you understand more, but this is just like an example, a scenario. It's something that plays out a lot in the market. And it usually works more on Euro USD. After we're done with this session, I'm going to enter Euro USD, see if I can just find a couple of examples for you. Alright, I don't know I hope nobody's lost. I hope nobody's lost. Can you guys hear me?
Yes, I have a question.
Alright, ask please.
All
Because I
right,
remember
so
the topic that I gave Chatopia students issued then. So please ask your question.
okay, so I want to understand the schematics more properly. So first off, you said I don't know if you've started mentioning the rules or you're just mentioning stuff we should observe.
No,
Because I'm already
those are the rules. Those are
okay. Those are
rules.
the rules. Okay,
Yeah.
because why? First you said we don't need an inducement, which is one, and
You
then
don't
two.
necessarily need an inducement. Yes,
Okay, necessary.
Inducement being present is just an added advantage. I don't know if you
Okay.
understand. It's just
Yes,
like
I
more
understand. Okay. Then it has to breach the short-term high with an imbalance, correct?
correct.
Which is necessary, I believe.
Correct. Yes, imbalance is very necessary. You must have an
Okay,
imbalance.
okay. All right. And then after the imbalance, it comes to take it out, right?
Sorry?
I mean, after the imbalance, we expect a retracement to come back and take out the previous low, I believe.
The imbalance. Look, the imbalance is breaking the structure at the short-term high that was created.
Okay.
I don't know if we're saying the same thing, it's just grammar.
Yes, it's the same thing. Okay, thank you.
Sorry, I'm coming. Just give me a moment. I don't know who is this person that has been calling me. Let me just text the person. All right. So back to what we're saying. Where did I stop? So I was giving the rule this thing. So I said, now the next thing I'm going to explain is when you're using short-term highs and short-term lows to trade, first you must see a liquidity sweep, you must see an imbalance, and you must see it coming back. You must see a liquidity sweep, you must see it breaching the short-term high that was created, and the breach must contain an imbalance. Now, there are several entry models you can use to trade this. You could trade basically using the FVG, that is, you taking trade off the fair value gap, or you could trade using order block. Now, in this case, when you see a short-term high and a short-term low, your order block is no longer the last bullish candle before the break or the last bearish candle before the break. No, that isn't your order block anymore. Your order block is the point where the character changed. Are we together? Can you guys hear me?
Can you give us an example on the chart? Maybe we understand it better.
I just want to make sure people are following me. I'm definitely going to give an example.
Okay,
Now,
thank you.
when you are trading off short-term highs and short-term lows, your order block would no longer be the last bullish or last bearish candle before the break. But at this point, you're going to regard your order block as the point where the character changed. Now, in this scenario here, this schematic I gave here, right? Your order block is going to be the body of this high candle, the candle high here, the body. Just so that you are omitting the wick, and you're going to take from the body here, altogether, of the candle that exists at this high. Let's go to EU charts to see if I can just get an example for you guys there. Euro shirts. Can you guys hear me? Can you guys hear me?
Yeah.
Yes.
All right, so I want to just briefly go to Euro USD chart, see if I can get you guys an example. I don't know who is this that keeps calling me. Euro USD. I think it's forex.com I use normally. Let's just use what I'm going to use. Let's take the forex.com, I guess. Okay, so this is Euro USD chart. 5 minutes time frame. This plays a lot on Euro. So in this on this trade, I'm the one that did myself. I was looking for something else. Ah shit. Can you guys hear me? Can you guys still
Yeah.
hear me? All right, you guys will have to give me a minute.
Yes.
You guys have to give me a minute. Let me just plug in my laptop. I was using it without charging it, so and I didn't realize the battery was low. So just give me a moment to plug it in. I would connect it back in a minute. Okay, but then meanwhile, before this thing comes on, does anybody have any question? Like so far, based on everything we've been talking about, if you have a question, you could just ask now before it comes on.
Are you listening?
Yes, I'm with you. Go
So
on. Sorry, one at a time, please.
Okay.
okay, Myke, you go on.
Yeah. So I want you to please re-explain that imbalance again.
Okay.
Yeah.
All right, no problem. No problem. Once I connect the PC, I'm going to explain that again.
Okay.
Idoko, your question.
All right. So my question is, can you, before it comes, can you help us maybe list out the rules one by one, maybe in another way we can identify this, then go ahead to identify this so we are able to recognize it easily. Then the second question is, do we trade short-term higher and lows mostly where there's a shift and maybe the market is about to change structure or anywhere on the charts?
Okay. Valid question. Now, I usually prefer trading short-term highs and lows from from discount levels or premium levels, right? Whereby you know that price is most likely going to drop down. Are we together? Now, this I can use it as both a reversal and a continuation pattern. That is the best part of it. It works both as a continuation and as a reversal. But then you have to time you have to get. Okay, there's this rule of three, right? There's this rule of three whereby you expect to see 3 liquidity sweeps before you want to start trading against the trend. I don't know. I'm going to show you examples on the chart once it comes on. So ideally, if you get your if it's the first liquidity sweep you are seeing in a long time, like in the whole trend, that is towards the end of the trend, it is the first liquidity sweep you are seeing, you can just target one targeted low, just the closest targeted low. You expect price to come back and take out that liquidity that was swept initially. So come back, it's still going to sweep that point. Because what I'm talking about just the lower time frame here. I'm not talking about higher time frame. Like I stated from the beginning, I'm a scalper. You see a second one, you can still target the closest targeted low or targeted high, just the closest targeted level. But then from the third one, you should be expecting a major drop. Because at this point now, okay, there's something that they call there's something that traders, people that trade for like banks and all these financial institutions, there's something they call footprints on the chart. Right? They call it footprints. Now these footprints are so I didn't turn on this socket. Okay, these footprints, right, are what will start hinting you that the trend is most likely going to change at this point. Are we together? It's going to start hinting you that okay, you should be expecting a change of trend. Now, those footprints are those minor sweeps you are seeing on the lower time frame. So the third one is the one that usually gives you all these explosive moves, like the one we caught on Ethereum, the one that I caught on Ethereum and I posted in the channel. Then that happened after the sweep. Are we together? Are we together?
Yes.
So mostly, as a
Yes.
person, I would recommend you wait for the second one at least before you take your trade of it. Or you could also take it once you see it rejecting from a premium or a discount level.
Okay. By premium or discount level, you mean a protected level, I believe?
No, not protected level. Premium or discount. Anything above the 0.5 level on your Fibonacci tool, is a premium level. And anything below the 0.5 level is a discounted level.
Okay. Understood.
Mhm. Okay, so the rules, I gave simple rules. First, you want to see liquidity. You want to see liquidity swept out. You want to see price creating a short-term high or a short-term low. Then you want to see that short-term high or short-term low gets taken out, and whatever is taking it out there must be an imbalance present. Once there's no imbalance, then it is not valid at all. Once there's no imbalance, wait until you see the imbalance. Even if you see another retracement, wait till you see the imbalance. All right. I don't know, is this connected to my router yet? I'm gonna keep them. Okay, that's connected.
Okay, that's 3 rules now.
Yeah, 3 rules.
Liquidity sweep, just to be clear, liquidity sweep, we have a short-term high or low created, then it must be taken out. It must be taken out, and when taken out, it must create an imbalance. Correct?
It must contain an imbalance, exactly.
Okay.
That imbalance is like the most important aspect of everything. If you don't see the imbalance, wait, because that is like one of like the final confirmation you need before you can take a trade.
Okay.
Can
Noted.
you see my screen? Can you guys see my screen now?
Yeah.
Okay, so
Yes.
back to the
Sorry,
explanation.
please.
Someone said I should explain what again?
Sorry,
Imbalance.
please. Is the class recorded? My network is bad.
Yes, it is
I
recorded.
haven't been here.
It is recorded. It is recorded. I hope at least I hope it will save. But I see record. So let's go back here. Okay, so like I said, imbalances. Once you take a look at 3 consecutive candles here, in a balanced market, it is expected that for every buy, there must be a sell. Are we together? Can you guys hear me?
Yes.
Yes.
So for every buy, there must be a sell. That is the standard expectation. Because I mean, let's say I'm bringing $1 to sell because I want to get cash. I need naira to spend. Someone has to be buying at my $1 so that I would get the naira at hand, right? Now, when the market is like that, you are set to expect price actions. You're set to expect price actions like this. It looks choppy, but this is a healthy price action because price always comes back to fill the gap because as you are selling, someone is buying. That is the healthy price action. Now, but in scenarios whereby people just keep on selling, people keep on selling, people keep on selling, and there is nobody buying, that is when you see candles like this. Are we together? Now,
Yes.
Yes.
imbalances are these gaps that exist between 3 consecutive candles, right? Taking this as candle A, candle B, and candle C, right? The gap that exists between the low of candle A and the high of candle C. The low of candle A and the high of candle C. That is this gap here is what we'll call an imbalance. The gap between these points and these points. Make sense?
Yes, sir.
It was Michael that asked, do you understand it now?
Yeah, I understand now. Thank you.
Okay, perfect. So this is what we're looking for. Imbalances mustn't necessarily be as big as this or as wide as this. There can be, you see, minute imbalances, something like this here now, for example. The one that exists between this candle here and this candle here. This is still an imbalance, no matter how you want to look at it. And price would most likely come back to fill it. Are we together?
Yes, sir.
Okay, so what was the other? What was the other question, sir? The other question was on the short-term high. I explained. So I said you want to see price. You want to see price taking out liquidity, moving upward, retracing a bit. Not when I say retracing a bit, it doesn't come back to take out this swing here. It doesn't come out to take this out. It doesn't return to this point at all. It just makes its minor movements, retraces, and come back to take that new high that it created, that engineered high or low. That is what we classify as a short-term high or low. And it's the same thing vice versa. Are we together? In a bullish market, in a bearish market, same rule. Does that make sense?
Yes, sir.
So I was explaining what I meant by using order block as the points where price changes, where price delivery changes. When you're using short-term highs and lows, you don't use the last candle, last bullish candle, or last bearish candle before the break for your order block. No, you use the points where the delivery of price changed. That is mostly this high, mostly the body. You always omit the week. The week doesn't really matter. Always omit the week. We use the body. I want if I can find an example, so I just use it for you as because I think it's way easier. But I don't really think GU barely ever gives us such things. It's usually EU. EU is the pair that's usually okay. I think this should be. Can this have no students? It's EU that usually gives us such examples. This is something that plays a lot on EU. Used to play on GU at some point, but I don't know. Lately, it hasn't been forming that much. All right, but here's an example, though. I think this should serve as an example. So here it is, a liquidity sweep over here. Obviously, market was bearish already. There was liquidity sweep over here. Where's my trend line? So there was liquidity sweep over here. Swap price taking this thing. Moved down. This low here wasn't taken. Observe that this low wasn't taken. This low here wasn't taken yet. We saw price first of all taking out this. Price first of all created this low, came back to take out the low, and there's an imbalance existing through or yes. We have this imbalance. Exactly. So now we're going to be using the body of this red candle here from this point up to this point here as our order block. This is our order block now to this point here to this newly created blue high rather. Now most people are going to use the this extreme here as their stop losses just to be safe and sometimes to avoid spread wahala. Sorry, someone is calling me. To use this is going to be the last example I will give. Then probably we'll just call it a day here. Then continue from pick it up from here tomorrow, please. All right. So this is going to be we're going to use up until this point here for our order block, and I hit the I left this tool on. Okay, so now we're going to draw this out. Remember, we're using from the top, from the body of this candle here to the high here. Use it as our order block. Our stop loss is going to just be somewhere up here, and our take profit would be, let's say, in this scenario, in this scenario,
Yeah.
in this scenario, we expect price take out this low. So this would have been where we would have put our take profits. And you saw how it went. This would have been a very good trade. Let me see how many are this could have given something around. Give or take. If you had placed this trade, you should have seen like let's say this close to Asha. So it's as easy as that, using short-term highs and short-term lows to trade. And in this case, this is a continuation model. In this case, this is a continuation model. But let's pick it up from here tomorrow, please. I don't really know why this person keeps calling me. And I want to find out why, because I think it might be something urgent. Are we together? So please, let's pick it up from here tomorrow. Any questions, guys? Any questions before I go?
Okay, yes. So you said for when trading short-term high and lows, we no longer use the what's it called, the last bullish or bearish candle before
As your order
the
block,
break or
yes.
yes. Instead, we use the what was the word you used?
You use the point where price changes its delivery.
Okay, instead you use the point where price changes delivery. And
Yeah.
how do we have identified that? How is
That
that
is
different
usually,
from the other block?
like I said, yeah. The point of where changes
Yeah.
delivery is it's just basically where it takes out the short-term high, right? Where it takes out the short-term high. But I don't call it a break of structure because it
Okay.
isn't an existing structure before. So I just use the word change of delivery because it's literally just changes mode of delivery there. Now you're going to be
In this,
you're going to remember you're omitting the wick. You are not using the wick of the candle. It's just the body of the first candle, the longest candle. Look here. Let's go back to this example here. Okay, good. Now, see where I drew from. I drew from the body. The whole wick, I didn't use the wick for anything. The wick is not needed. You're going to be taking it from the body of the candle
okay.
till this high here. Now I can just put your stop loss here or put your stop loss here to play safe. Are we together?
Okay.
But then this is something that you can still go and backtest, but we'll still pick it up from here tomorrow because after this, I'm still going to have to explain liquidity sweep and some other things, right? And show you guys live examples on the chart. So we'll have to pick it up from here tomorrow. Are we good with that? Are we good with that, everybody?
Yeah.
All right. So, I think this is where we'll have to call it a night. Do have a wonderful night, guys, and see you tomorrow, same time.
All right.
Okay.
Thank you.
Yeah. Bye bye.
Good night.
Good night.